Hey, I'm Chris Rowe, and if you don't know me yet, I am just Chris Rowe. I'm just a money manager. I've been a money manager for 25 years. I grew up on Wall Street, but I'm not a Wall Street douche or anything like that. Don't worry, I'm all right. Now, I spend most of my time advocating for individual investors and selling cool things like tools and apps that help people invest. And I teach people stuff too. And usually I charge an arm and a leg for it, but today I'm going to do it for free. And I'm going to answer some questions from some of my sector-focused members, right? So I have followers, they ask me questions. So today we have a question about options from Dennis. So today's your lucky day, Dennis. I chose your question to answer and send out to all sector-focused members. By the way, usually I'm very exclusive. I'm just now getting onto YouTube, and so let's see if we can get me some YouTube followers and subscribers. If you like what you see here, like it, comment, I will answer you back, and just subscribe to my channel if you like it, all right? Share it if you love it. All right, questions are about entering options trades. So this one is, buy to open, sell to close, sell to open, sell to close. So here comes a question from Dennis. It's Chris, I purchased McDonald's put. It expires on December 31st at 270 strike price. You guys don't need to know all this. That is, just know that Dennis bought an option. This is my first time buying and selling an option. So when I sell on or before the expiration day, I have two questions. Under transaction, it gives me two choices, sell to open or sell to close. And a second question is under price type, it gives me four choices, market limit, stop limit. Which are the proper transaction and price type that I could use? All right, so here we go. Dennis, we're gonna answer your first question, which is under transaction, it gives me two choices, sell to open or sell to close. All right. First, please keep in mind that we can't give personalized investment advice, and this is not advice, all right? This is a general answer for educational purposes only. Always check with your registered investment professional before making any trades. So, sometimes various brokerage platforms ask that you specify when trading an option to buy to open or to buy it to close, or to sell it to open or to sell it to close the trade. So let's start with a very basic scenario, and this is going to be the scenario that Dennis specifically is asking about. And then I'll dive into some other scenarios just so we cover all of our bases here. When a buyer of an option contract buys a call option, assuming this option trader does not already have a short position in that call option, is just coming out for the first time buying the call option, they want the stock to go up because that'll likely cause the call option to also go up in price. All right, the position is entered as buy to open. Then when the trader wants to exit that position, they will close it out with sell to close order, hopefully at a profit. When a buyer of an option contract buys a put option, assuming this option trader does not already have a short position in that put option, but when they just go out and buy a put option, they want the stock to go down because that will likely cause that put option to go up in price. This is because the put option typically has an inverse price relationship with the stock. It's a good way to bet on it going lower. So when a trader thinks the stock or an ETF is going to go down and they buy a put option to try to profit from that potential price decline, position is entered as buy to open, just like the first one. Then when the trader wants to exit the position, they're going to close it out with a sell to close order. Sounds pretty simple, right? To open a new position, we enter it to open, and to close a new position, we enter it as to close. So why do we even need to specify to open or to close if it's that obvious? It's because sometimes we open our positions with a buy order, and other times we open our positions with a sell order. This confuses some people. The differences are pretty simple if you understand that one can sell first and then buy later to try to capture the difference in the form of a profit. So for example, a trader sells something first when trading options. This would be a sell to open. Hypothetically does it at $5. Trader might try to buy that stock or that option back at $3, capturing the $2 profit. In this case, the sale happened first and the buy happened second. The stock or option was bought at $3 and sold up at $5. The only thing is the sell happened first. So when this happens with a stock trade, it's commonly known, as you probably know, as selling short or short selling. In this case, the stock is technically borrowed by the short seller. And then once it's sold, the hope is to buy it back cheaper. But of course, as the stock goes up, the position is losing money, losing value. So for example, if stock is sold at 10 and then it goes up to 12, the trader is down $2 times the number of shares that was sold short. In the case of an option contract, very similar, the trader that sells the option is not borrowing at first like the stock, okay? In the case of an option, there's not a finite number of shares or options contracts. In the options market, when the trader is opening the trade by entering the sell order, that trader is actually creating known as writing the options contract. It sounds like a lot to process, but rest assured, all the trader is doing is clicking on a few buttons on the platform. Very simple. It's not actually taking a pen to paper and writing a contract. So this is known as writing a call or writing a put. This is done to open. Okay, the opening transaction is a sale. Options can be bought or sold during market hours, just like any stock. You don't have to hold on to it. When an options trader sells short an option or writes that options trader is effectively obligating his or herself to making a trade of the underlying stock or ETF if asked to do so by the buyer. So for example, if the option seller sells a call option, that trader is saying that they're willing to sell someone else the underlying stock or ETF at a specific price. If the option seller, for example, sells a put option, that the trader's now saying that we're willing to buy the underlying stock or the ETF from somebody at a specific price. That's what happens when you sell a put. So the options trader can and usually does close out that position, eliminating that trader's commitment by buying back that option. So for example, you can enter a trade to open to sell a put option at 10, making the commitment that you're going to be buying that stock at, let's just say, $55 a share. So if that put option goes down to 4 from 10, the option trader closes the position by buying that put back, buy to close. That put seller is no longer obligated to buy that stock at the hypothetical 55, and also made $6 in the process. Sold at 10, bought back at 4. I hope that this helps anybody who's interested in trading options. We strongly recommend that any investors who are looking to trade options, by the way, get educated on the risks of the options trading first. I want to say something about that, okay? Although options contracts were, originally created as a means of increasing safety, they're viewed as insurance on stocks or insurance on ETFs. They're actually a highly leveraged investment vehicle, and they're therefore typically very volatile. Your brokerage firm will provide you with the options risk disclosure manual when opening an options trading account. So I always tell my followers that options contracts, they're kind of like a brand new Ferrari with new tires, new engine, new everything. And that Ferrari can go 260 miles an hour. And that car is much safer than a 1985 F-Series Ford with 200,000 miles on it, balding tires, squeaky brakes, and no airbag. Okay, the Ferrari is safer. But the Ferrari becomes the more dangerous vehicle when the person who doesn't know how to drive stick shift gets behind the wheel of the Ferrari and gets too excited about putting the pedal to the metal and just pushing that Ferrari to the max, that 260 miles an hour, in a rainstorm or something crazy, just for the rush. So is the car or the person the problem? When used correctly, options reduce risk. When used irresponsibly, they elevate risk. It's as simple as that. So be sure to understand the possible outcomes before trading. All right, so there's more. So that was under the transaction. It gives you two choices: sell to open, sell to close. When we're entering the position, we're selling to open. When we are getting out of it, we're selling it to close. Okay, so the next one is under price type. It gives me 4 choices: market, limit, stop, stop limit. Which is the proper price that I should use? All right, so once again, I can't advise you exactly what to do specifically, so this is for educational purposes only, but limit orders are what I like to use when trading options, unless there is a very small spread between the bid and the ask, and I'm chasing it. So if you don't know if the spread is big or small because you're new, just look at the spreads of similar options on other stocks, similar ETFs, just for comparison. But if it's a very popular option, very popular stock, heavily traded stock, lots of volume, generally the options are going to have very small spreads, lots of volume, and it'll make market orders more viable of a choice. But having said that, I like to use limit orders anyway, pretty much always, unless it's a very, very fast market and I'm trying to get the trade done as fast as I possibly can, and I'm very eager to get in. So here's what we add to all trade ideas in something else that I publish called Checkpoint Trader. After every trade, it says fishing for a good price when buying. It says after entering the trade, it would make sense to wait for a minute to see if that trade gets done. If not, and the price hasn't moved, then it makes sense to cancel and replace your limit order and replace it at a price that's slightly higher than the mid price between the bid and ask. Higher because we're buying something, and to enter a buy order at a higher price means you're becoming more aggressive at trying to get that trade done. I like to repeat that process over and over again, rinse and repeat, until my trade is filled. So when fishing for a good price when selling, the price, changes obviously. So when you're fishing for a good price when selling, the way to sell a position is to find the mid price, again, between the bid and ask, and go from there. So if you're more anxious to get out you might enter the sell order a little bit lower than the mid price between the bid and ask. And if you're fishing for a better price, you'll enter the order slightly higher than the mid price. After entering that trade, it would make sense to wait for a minute and see if the trade gets done. If the trade doesn't get done and the price hasn't moved, then it makes sense to cancel and replace the limit order and do so at a price that's slightly lower than the mid price. Lower because we're selling something, and to enter a sell order at a lower price means that you're becoming more and more aggressive at trying to get the trade done. Okay, so you enter it at a lower price, more appealing for the buyer. So I like to repeat that process until I get my trade filled. So that's it. A market order means you're going to sell at the highest bid, the bid that they're showing you. It's basically going to be the lowest possible price because you have the bid and the ask, you have a spread. So if you're selling at the market, you're going to be selling at the bid. If you're buying at the market, you're going to be buying at the asking price. If you want to fish and get a better price, especially important when you have a big spread, you want to enter a limit order. And that's pretty much it. There's also stop orders, and just as a side note, so the stop order is like a sell stop order. If you own something, you put in a sell stop order. What that means is if a stock is tanking, it goes from 100 down to 70, you have a sell stop order at 65. That means if the stock goes down to 65 or lower and trades at 65 or lower, that will automatically turn your order into a market order that sells at the market price. This is a really bad thing to do with options because of the way that options are priced. With options, you probably want to use what's called a conditional order, and you're going to have to learn that from your broker or on another video. Stop limit order just means that same stock that goes from 100 down to 70, and you have your stop limit order at 65. What that means is if the stock trades at 65 or lower, then instead of just selling your stock at the market like the previous one, it will enter a limit order to sell your stock at whatever you want that limit order to be. So it's kind of like a conditional order in a way. But anyway, that just about covers it. Again, if you liked this, then click like. Share it with your friends if you think it'll help. But absolutely subscribe to my channel. I'd really appreciate it. And if you want to help me out, you can just share it on Twitter and YouTube and not YouTube. See how old I am? Share it on YouTube. We got to call YouTube and get the YouTube down here to interview us. If you guys watch The Office, I'm a big Office fan. All right, so subscribe, and I'll see you on the next one. Take care. I'm Chris Rowe.